Florent Albers, you are Senior Director Structured Finance at Scope Ratings. Thank you for joining us on BiTV.
Thank you. Pleasure is mine.
In a recently published note, Scope Ratings reported that, and I quote, 20% of the loans in European CMBS maturing this year and next face very high refinancing risk, and that another 14% face high risk if swap rates rise another 100 basis points. What is the cause, sorry, of this pressure on European CMBS?
CMBS is securitization of CRE loans. Therefore, the securitized CRE loans that are generally floating rate loans in Europe are floating against Euribor or SONIA rate, generally 3 months. These rates have increased by more than 300 basis points since 1 year. So, for example, the Euribor rate was minus 55 bips in February 22. It's now more than 2.5%. In the meantime, we know that the central banks, namely the Bank of England and the ECB, have already warned markets that further increased rates will come this year. Estimates vary between 50 to 100 basis points. On top of that, the lenders have repriced the debt of CRE loans and increased their margin by, in general, 50 bips. That's what we see in the current transactions we are assessing. So in simple terms, a euro loan, senior loan of 60% loan to value that was priced for 2% coupon a year ago may be now financed at 5.5%. And maybe at 6.5% before you end. Therefore, in other words, that means for a sponsor, its cost of debt can have tripled in 18 months. So this is without considering the hedging costs that have also increased and the liquidity that's dry because some lenders are cautious about financing some type of assets. Now, if in the meantime we look at what's happening on the asset side, so not the financing side, but the asset side, the performance has been quite mixed with volatile performance and pressured property values exposed to these widening rates and the lack of trading. So, for example, retail and office sectors have been amongst the asset types that have been the most exposed and victim of the recent crisis. Both if we think about COVID, the remote work, the e-commerce and inflation. So that plus the outlook that is quite challenging for these asset classes means that lenders are quite cautious in terms of financing non-prime and non-green assets, especially in retail and office. And therefore their assumptions in terms of what should be the minimum occupancy rate, the capitalization rate, and the rents are really cautious. And that's why, for example, we saw last week the first loan in the CMBS to default in the recent history, so in the last 2-3 years. And that's a frozen loan that is a loan that was securitized by assets in Sweden, so in Finland, that were mixed use, so retail and secondary office assets.
And therefore, maybe the main question is, what are the main risks facing commercial real estate borrowers in the current context?
So with my introduction, I already highlighted some of them. So one is indeed the higher for longer inflation interest rate environment, where we cannot expect anytime soon the base rate to go back to levels we have seen over the last decade, and it's likely going to go higher than lower. We also see, as I mentioned, the lending policies of lenders, traditional lenders, especially banks, to be tighter. So these banks are retrenching from some of these CRE markets, especially for non-stabilized assets that are extremely costly in regulatory capital. And in general, the lenders are more cautious with more stringent requirements in terms of lower LTV, higher margin, higher DPI requirements, etc. As I also said, the property value are pressured with higher capitalization rates and an uncertain outlook. That leads also to a spread between what's the value that the sellers see in their assets versus what the buyers are willing to pay. And finally, in all of this, you have a quite significant need for additional capital, fresh capital, to inject in these assets to address the challenges of the structural changes we are seeing. So in terms of decarbonization, digitalization, et cetera, et cetera.
And because of those pressing need for further investment, and as real estate investors look to navigate these muddy waters, these financing struggles, let's say, how could this pressure on real estate loans affect lenders and real estate financing more broadly in 2023?
So lenders will be affected in different ways according to their risk return profile, the typology of their financing, and ultimately the quality and the nature of their securities. Senior lenders will probably see some of their loan covenants to be breached. I'm thinking about LTV or ICR levels during the term of these loans, which should be quite manageable given the short-term nature of these loans. What is more problematic is refinancing risk, where these lenders may have to decide to either refinance some of these loans in their portfolio at a higher kind of risk level, or to reject refinancing at the risk of the sponsor to default on its loan. So ultimately, they will have either to accept to foreclose these assets or to accept to renegotiate the terms of the financing with the sponsors. So here, what we generally see is loan extensions, and again, some better securities or better pricing for the lenders. We have actually seen the recent weeks sponsors and servicers of 5 loans securitizing CMBSs to extend or asking an extension of the loan maturity. We're actually going to issue a note in the next 2 weeks about this, because it shows how all market participants are trying to avoid a default at refinancing. On the other hand, mezzanine lenders will need to be more hands-on on their loans, and loss will likely crystallize once sponsor will fail refinancing. From a sponsor perspective, here refinancing planning, asset management strategy, and access to capital will be paramount to prevent financing default. So that will be more from a stakeholder / debt side. Then on the asset side, what are the consequences? So one of them is that the value of these assets may change. We are especially scrutinizing assets that have very, very low yields, because for these assets, a change of 25, 50 bips will have a significant impact on their value. Here we are thinking about also assets that have been challenged in general, so some prime office, some residential and logistics assets that were really low yielding. We're also extremely cautious about secondary office and shopping centers, for which the outlook is negative. We have seen in the recent news that, for example, The Rock, a secondary UK shopping center, have seen its value dropping from 90 million to 39 million in 2 years. So more than a 50% market value decline. Finally, I would say that there is an ongoing exercise discovery exercise about the real value of some of these assets, where the perceived value from sellers may be really different from the ones from the buyers. So this is just a natural consequence of the change of paradigm between the last decade of accommodating real estate real rates and the normalization of these rates that we are currently seeing. So ultimately, refinancing planning and the overall access to capital will be really important to prevent refinancing defaults.
Great. Well, thank you very much, Florent Albert, for this very valuable insight in this, let's call it, tumultuous time for real estate investors and in real estate financing in general. Thank you all also for joining us, and see you soon on BiTV.
Thank you. Bye-bye.